Listen, want to let you know that I did a deep dive Q&A with David Stevens yesterday live on the Frank Ray and Brian Stevens Facebook site. We went an hour, and let me just tell you this. What you think you know about the future of the mortgage business, you don't. You really want to check this thing out. All you have to do is click the banner right down below to watch the video. And do me a favor, if you like it, hit share. Okay, so on with the show. Did you guys know that the average turn time to close on a mortgage has decreased for the 4th month in a row to 51 days? And this is according to a new study from ICE Mortgage Technology. Now, do you know what that means with our turn times getting shorter and shorter? So do you know what it means to have shorter turn times on mortgages? Now, you're all thinking out there right now, there's nothing to think about this and you'd be wrong. It means that good processing and other mortgage-related staff is going to become available for you to hire in the very near future, because faster turn times means too much staff for too few loans. Guys, mortgage companies right now, they're staffed for last year's production today.
That also means that recruiters should be stepping up their game. And because some loan officers' originations will slow down, some will blame their company for the cut in their pay and start looking for employment elsewhere.
Because here's a hint, loan officers. If this is the core reason for your pending departure from the mortgage company that you're currently working at to move from company A to company B, I'm telling you, it simply won't work.
And understand this. For April, 56% of mortgage production was refinances and 43% purchases. However, when we look at FHA, 21% refinances, 79% purchases. Now this is pretty interesting. If we go all the way back to December of 2019, FHA refinance volume has never exceeded 25%, whereas over the same period, conventional mortgages have never been lower than 53% of production.
FHA refis never higher than 25% of production. Conventional, never lower than 53. What should that tell you? Well, FHA Streamlined Refinances are either being ignored, highly unlikely, or because of massive market appreciation over a very short period of time, FHA's book of business has shrunk as you've moved your client base out of FHA's MI into conventional loans, which, by the way, I just confirmed with David Stevens on the interview that we did. So with a shrinking portfolio, FHA's absolutely massively bloated MMI fund, somewhere to the tune of $65 billion, is now safer than it's ever been and continues to grow exponentially. Think about this for a second here. Now think about this. Their untapped fund is insuring fewer loans, so the percentage of their portfolio increases with every FHA to conventional refinance. Why do I bring this up? Well, because HUD needs to knock 50 basis points off of the MI on all of FHA's products and return that savings to future homeowners that use the FHA, which, by the way, also in the Dave Stevens interview, I verified that. Seriously, buying a house is expensive enough right now. Let's quit gouging with unnecessary inflated mortgage insurance fees. Now, the second thing this should tell you is
HECM's reverse mortgages. Now, we did an interview on this. Those reverse mortgages are not getting refinanced into conventional loans. Nope, they're just sitting there waiting to provide a few loan officers with some fabulous production this summer. Kathy did 28 HECM refinances over the last 3 months. This is a massive opportunity for some loan officers who are willing to take the initiative.
And get this, VA is tracking very much like FHA. In April, 31% of the volume was refinances, 69% purchases, and VA rate reduction refinance production never got above 36% over the same period since December 2019. You know, I think lenders right now are so concerned about accusations of churning your VA portfolio that these VA rate reduction refinances are kind of going unwritten right now. I hope that's not the case. Now, from the report, here is some seriously sad news.
Of all the loans written for April 2021, only 6% were VA. Last month, only 3% were VA. We are writing about the same amount of non-QM volume as we are VA volume. Now remember, non-QM didn't even exist a few years ago, and in a couple of months, it's going to outpace VA production.
As the market stands right now, VA loans have been rendered nearly obsolete, and that stinks. We need a couple of things. One, more VA education for real estate agents and sellers. And two, VA needs to look at loan limits and move them to make VA loans more viable in high-cost areas. Now, for all of you VA experts out there, I get it. there's no VA loan limits. I get it. Let's increase the amount covered by the funding fee so VA loans can be truly no down payment in many markets. Remember, only 6% of all loans written for April 2021 were VA loans. Our vets, my friends, deserve better than that. All right, I'm gonna kick this horse one more time. Make sure you check out the Dave Stevens interview. All you have to do is click this link down below. If you like it, forward it and keep the conversation going with your sphere of influence. Realtors, lenders, talk with each other about the changes because they're massive and they are in fact coming. That said, I can't wait to see you all again tomorrow here at the National Real Estate Post. Ciao, Maine.